Welcome to Perspectives from HSBC. Thanks for joining us. And now, on to today's show.
Hi, welcome to our Perspectives series, recorded live from the Global Investment Summit in Hong Kong. I'm Lisa McGeough, CEO for HSBC in the United States. I have the privilege of speaking today with Jenny Johnson, President and CEO of Franklin Templeton, a global investment powerhouse with over $1.5 trillion in assets under management. Jenny, it's fantastic to have you here.
It's great to be here, Lisa. Thanks for having me.
Oh, it's a privilege. So today we're going to explore how Franklin Templeton is adapting to market shifts, integrating new technologies, and driving innovation while meeting the evolving needs of investors. So we're going to dive in. But Jenny, this is the third day of the Global Investment Summit. So before we talk about Franklin Templeton and your impressive tenure, you have 30 people here.
We do.
And I would love to hear from you and the official Franklin perspective on the Global Investment Summit and whether HSBC has delivered for you.
It has been a tremendous lineup of speakers that you guys have brought in. And of course, you have clients from all over the world,
Yes.
which is fantastic for us because we get to meet these folks and have great conversations. So it's really been impressive.
Wonderful. Thank you so much. So you've been with Franklin since 1988, and it's wonderful to look at.
I am that old.
Yeah, well, hey, I started in the 80s as well, so we're the same class. You've played a really key role in shaping the evolution of Franklin, and now you're at the helm as CEO. What are the biggest shifts you've seen in asset management over the past, several decades? And how is Franklin adapting to stay ahead?
Yeah. So, I think that some things have not changed since I began, and frankly, since my grandfather started Franklin Templeton way back in 1947, which is we're here to meet clients' needs to the most important financial goals of their life, right? And to work through advisors who are right at the tip of the spear, having those conversations with clients. The beauty is that the tools have improved, the investment opportunities have expanded, and so we can really personalize clients' portfolios in a way that you haven't been able to do in the past. There's a huge growth in private markets, and I think that's a secular change. One, companies are just not going public. There's enough money in the private markets to stay private longer. So what used to be in 2000, average 3 years they were going public. Now that's 10, 12 years, right? So those early growth years are captured in the private markets. And I don't think that changes. And then the second thing is that, banks, the regulations around their capital requirements have gotten restricted or restrictor. And so they can't lend like they used to lend. And that's created this massive proliferation of private credit. And so what you saw is that initially a lot of institutions have about 30% of their portfolio that is allocated to private markets, whereas the individual investors only 3%. And so I think there's going to be a shift to the private markets. And then I think there's, disruption with things like blockchain and AI that are, coming down the road.
Right. Jenny, could you talk a little bit about democratizing private credit? Because that's been a trend lately, and I think you've been at the forefront of allowing your clients to access private credit. Maybe I remember you always had a fantastic loan fund, and Franklin always has deep expertise in lots of areas. But private credit, how are your clients accessing that market?
Yeah, so we acquired two companies, Benefit Street Partners and Alcentra. So it's European and U.S. private credit primarily,
right.
The challenge is that this is permanent capital, which is why it works well, right? So historically, these alternatives managers would raise a fund and you didn't get liquidity until they monetized whatever their investments were.
Right.
That's very challenging to the average individual who may need their savings because of a life event that comes up. And so the type of vehicle that we are launching are things like we have what are called evergreen funds in our private credit area, in our real estate area, in our secondary private equity, where you can redeem up to 5% a quarter of your holdings.
Okay.
And so you build a structure, you probably keep a little bit more in cash there to be able to meet those demands. The reality is not all clients need that 5%, And so it gives the excess returns, it gives the individuals access to those excess returns. There's other ways to do it. We think tokenization is going to be helpful in the future. But the key is, and this is where I believe so strongly in that financial advisor working with the clients, because you really have to understand a client's spending patterns, their saving patterns, to understand what the right vehicle is and what the right amount of allocation of private markets. So we work with HSBC, for example, as they're talking to their clients about bringing those types of vehicles to give them access.
And I think the other point about that is that the education of the financial advisors is even more challenging now than ever, because the markets are moving, you're evolving your product suite and the tools available. Maybe could you dive into that a little bit?
So great point. So we have the Franklin Templeton Academy, which we learned, one is to be able to talk to advisors so that they can understand how to think about, they kind of get it that, okay, there's excess returns because you get an illiquidity premium, but how do I fit it in those clients' portfolios? And I've got different client needs. And so our academy, we have a lot of education on that. We also have 90 people that are dedicated to just being alternative specialists globally. So when what we call a market leader is out working with a financial advisor talking about the various Franklin Templeton products, they can call in a specialist to say, oh, you want to go deep on private credit, for example, let me bring this specialist in and really work with you so you can understand all the nuances of it.
Okay, so putting the client at the center, making the whole organization work for that client, understanding their needs is really critical.
Yeah, and I do think that it is often folks who haven't worked in that wealth channel. So alternative managers who have been selling to institutions, you talk to a pension fund, they know exactly what their cash flows are, right? But that financial advisor, like I said, they not only need to understand the client's savings patterns and the size of the portfolio, they need to understand their spending patterns. They need to understand what life events are going to come up where they're going to need liquidity.
Right.
And so I always say they're the tip of the spear, and they risk if they put the client in the wrong type of locked up vehicle, it really is a risk to them. And so being part of that education, really helping those advisors think through it, we think is really important.
Okay, that's super helpful. And Jenny, so you're north of $1.5 trillion of assets under management. We talked a little bit about some of the acquisitions you've made. It's a competitive environment, but you're in a great position. How do you think about the Franklin Templeton portfolio and some of the acquisitions that you've made thus far, and where do you feel like you might have gaps?
So many people know us as, sort of Franklin Templeton, primarily an active manager. We have since acquired Clarion Partners, which is our real estate managers, Lexington Partners, which is secondary private equity, and as I mentioned, the two private credit managers. We also have launched our own venture capital fund because our Franklin growth team is based in Silicon Valley, and they were noticing that they were losing those, they weren't getting those return kickers because there weren't IPOs coming to the market. So they started to do late stage venture, which kind of replaced that IPO, and you can hold up to 15% in mutual fund in illiquids. And so that got them into the venture business, and we had clients actually come to us and say, hey, you're doing this, you're doing this, will you launch a fund? And so being housed in Silicon Valley, I think gives them an advantage. And honestly, being part of a growth equity team is also an advantage, because sometimes I think the VCs convince each other of valuations, but if you have the discipline of saying, wait a second, let me look at what the equivalent in the sector is trading at in the public markets, sometimes the best deals were the deals you stayed out of because you knew they were overvalued at that late stage. So anyway, so we got in there. So today we're, I think, the 7th largest alternatives manager. And if I were to say that there was any area that we don't have in scale, we have a couple small teams, is infrastructure, which I think is going to be both on the debt and equity side. I think there's a lot of opportunity there with the kind of energy transition, and so that's an area that we would love to acquire if the opportunity came up.
Okay, all right. So always evolving. AI and blockchain. So we hear a lot about this, how it revolutionizes financial services. There's a lot of buzz, but how are you really using it to increase productivity, increase effectiveness of your teams? And with that productivity, where do you go?
So if you look in history, anytime there's a new technology that comes in, the first thing that people tend to do is they make more efficient what you do today,
Sure.
right? So that's all you do. You look at it, you say, how do I be more efficient at that? And then what happens is as your staff gets more comfortable with the tool, they start to figure out opportunities to innovate. So I think when we look at AI and you look at from an investment opportunity where most of the investment opportunities been, it's been in the picks and shovels, the Microsofts who have the Google Cloud, Microsoft, AWS, sorry,
okay.
Google. So the cloud service providers, the NVIDIAs, the chip providers,
Yes,
right?
yes.
The next phase is going to be, I think, which companies figure out how to get that competitive advantage. And initially, it's going to be operational efficiencies. So at
Right.
Franklin Templeton, we're doing a lot looking at kind of those operational efficiencies. But then it's going to be where the revenue opportunities. Now, we launched, we have a partnership with Microsoft where they're helping us build a platform along our distribution team. So, as you can imagine, I say it's a simple problem with a complex solution, right? So the problem is, if I'm a market leader and I'm going to go visit a financial advisor, I want to say, what's the optimal meeting agenda and topic, right? So then you go from a platform, your AI goes in, it'll go into your CRM system. It starts to look at, okay, let me understand the patterns of conversations. Maybe let's go look at what information I have around that advisor's portfolio. Let me go into, say, a Morningstar to see some of the ratings. Let's look at the Franklin products that make the most sense. Maybe I'll look at social media to figure out what that advisor, what's going on in his community, right? What creates the best conversation with that advisor to both be efficient with that advisor's time and connect with the advisor. And so you build an AI platform. Now, initially, most people are doing what are large language models and other, which are just kind of a set of data, and the model goes in and gets information. This is actually an agentic platform, which means you sort of give it permission to go out and find additional information to add as it finds it's valuable. It's like it gives the model permission to go out. And then what happens is it comes back, as you of course know the hallucinations, it comes back and you say, well, that's not quite right. And so the model starts to learn. You could imagine a similar thing for your investment teams, right? So let's say, China obviously came out with DeepSeek. It was a really aha moment in the US on, wow, we thought we were so far ahead and it was going to be so expensive. So imagine if you're an analyst covering that, you can say like, okay, let me understand all the ways in which DeepSeek could be disruptive in what industries. Well, by the way, it's obviously from the chip making industry, but maybe it's the energy industry. Then I start to look at oil, right? And so there's a lot of different things that can come out of that. And so if you have this agent that helps you sort of sift through, you can sift through all your own research reports, the street's research reports, right? You know how long it would take you to do it yourself, right? And pull out the salient information. So we think it's going to be a really powerful tool. It doesn't replace the human, but it enhances the human's ability and knowledge.
So it's productivity, but it's relevant content for the problem you're trying to solve. And when you think about, I'm sure the engagement levels with clients are as high as they've ever been, given what's going on in the world. So your financial advisors have the opportunity to sort of synthesize all of this and make it make sense.
100%.
Okay.
And then let me just go into the blockchain answer.
Please.
So look, we're big believers in this. We launched a tokenized money market fund in 2000. Why do we think this is important? And again, it's a vehicle in which you'll be able to deliver, just like an ETF as a vehicle, others, that you can deliver investment mandates and capabilities. So first, to think of it that way. So think of the technology, put Bitcoin aside and say technology does a couple things. It has a source of truth as far as ownership. It has the ability to execute a smart contract. So whatever the rights and agreements are in a transaction are programmed into that token, and it has a payment mechanism. And so we think that people will tokenize alternative assets. And now I can trade it. I can go straight to you, Lisa, and say, do you want to buy my token? And you have all the rights in that asset. I don't need to go to a third party. Today, much of financial services requires you to go to a third party because you don't know the counterparty. And you don't know that the counterparty has all those rights. But if you have it programmed into the token, it actually brings those rights in. So it takes the frictional cost out of a lot of transactions, which we think will open up more investment opportunities. So things like song royalties will be able to invest in them, right? So, and Rihanna, I love giving this example. Rihanna came out with 300 NFTs. Each one has I think it's like 0.006% royalty to one of her songs. Well, how can she do that? So if I buy it, Spotify or whatever streaming service plays the song, the smart contract kicks off, says, oh, Lisa has this token, because I'm sure you're a Rihanna fan. And
I am actually.
I have to pay her for her royalty, right?
Right.
You couldn't do that today.
That's fascinating.
Right? Institutions can invest into royalty programs, but the individual can't. And so we call them cultural assets, where people's portfolios will be able to participate with their favorite sports athlete or their favorite song, singer. So I think it's going to be a really interesting evolution.
And Jenny, I'm just so impressed by all of these areas where you're, evolving, innovating. It adds a competitive edge to what Franklin provides. But where do you get these ideas?
Well, I do think that we're headquartered in Silicon Valley, so that's certainly been helpful.
Yes.
I ran technology at one point, so I have a natural curiosity towards it. But honestly, I just came from China, and there's some tremendous innovation that's happening there. I mean, I think China, in many ways, is probably ahead on EV battery. Yes. The stuff they're doing in robotics is incredibly interesting. Obviously we heard the DeepSeek story. I think with AI, all these models are going to kind of keep jumping ahead of each other, which is why as both an investor and somebody using them, you should probably diversify the sources that you leverage. So you have to just have a curious mind. I mean, we're living in a time of great change, and you can't approach it with fear. You have to approach it with curiosity and say, how can I think about leveraging this tool?
Okay, and then seeing around corners, right?
Yeah.
And we
hope
to. So if you think about the industry 10 years from now, talk about seeing around corners, the most disruptive forces shaping asset management. And maybe are there areas where the industry isn't paying enough attention to?
Well, I do think the two most disruptive are AI and blockchain. I think the industry is paying a lot of attention to AI, and it's challenging, right? It's challenging because it's hard to find the talent to really understand it. It's challenging because AI requires a lot of data, and by the way, data has to be organized. The dirty little secret in so many of our companies is it's hard to organize your data.
Yes.
It gets proliferated, and it's there's no kind of, in the U.S. we have the Dewey Decimal System to find books in a library. Right. You kind of need that on your own data. And so those are all challenges to it. But I think that everybody's focused on solving it. In the case of blockchain, I think it's mixed as far as people's adoption of it, because there's a lot of skeptics who sort of just say it's akin to crypto and blockchain, Bitcoin, and those can get a big debate, instead of just saying, well, yeah, but this is a really efficient technology to leverage. And I do think that ultimately, you say 10 years from now, I think an HSBC advisor will talk to their clients about their portfolio and talk about three things. They'll say, here's how you're performing towards your goals. Mm-hmm. So you're meeting your goals here. Here's been your investment returns to meet them. Here's the impact your portfolio's had, and it's going to be really customized to the client's desires for impact. Maybe it's energy transition and sustainability. Maybe it's gender equality, whatever it is. But the data is going to get better and better, such you'll be able to talk to your clients about that, and it'll be part of the scorecard on how a portfolio is. And the final piece is you'll say, by the way, here are all the benefits, the loyalty benefits you get for owning these companies. So today, apparently, if you own certain types of NFTs on Nike, you get access to specific sneakers that only you will get. There is not exactly well executed, but the concept's important. I think it's a St. Regis in Aspen that's been tokenized, and when you check in, they say, "Oh, Lisa, I understand. I see you're an owner. We've given you a room upgrade." Right? It's going to be a loyalty program tied to your ownership to that equity. And that's, I think, going to be part of sort of the overall portfolio story.
That's fantastic. Okay, super interesting. A little bit on ETFs. You and I talked about this in Miami a bit. Massive rise over the past 2 decades. Talk about this as an investment vehicle in your business. Where is it heading next?
We've seen, massive growth in ETFs. It's a great vehicle for a lot of strategies. There are some strategies that I think it's better to be in a traditional mutual fund,
Okay.
or say even an SMA, depending on the, separately managed account, depending on the client.
So again, another area where advice of your financial advisor is going to be critical.
Absolutely.
Yeah. Okay. Wonderful. So we were together in February at the FII conference in Miami, which was quite a thing. You made comments about risks in the market that were quite different to the other panelists. Could you talk about the U.S. government debt theme? We're looking at $35 trillion. I guess we're not sure if there's going to be a Mar-a-Lago Accord. The dollar gets weaker. I mean, how do you think about managing around this topic?
I think I said it then. It's not a problem until it's a problem, right? And the problem is, so of the G7 countries, all of them, with the exception of Germany, are at least 100% of GDP to debt, right? Like that's kind of emerging market type numbers, right? So rates had been low. If rates stay higher and you have these refinancing, suddenly the amount you have to cover in interest payments is going to go up. So that's always a concern. But the biggest issue, I think, is take the U.S. So we went from $9 trillion in debt in 2007 to now $35 trillion. And we're adding anywhere between $1.5 to $2 trillion a year. Our largest foreign buyer of U.S. debt is Japan at $1.1 trillion and China at $850 billion. So those are arguably your two biggest customers, other than the U.S. government Fed buying it itself, right? Which is inflationary. So chances are they're not going to increase a lot. So you need buyers. And to me, the point I was making at the conference is it then starts to squeeze out other investment opportunities because, in the end, it's not a threat to the dollar, right? The reality is there's not a lot of other places to go. So the dollar still maintains itself as the reserve currency. But at what price do you have to attract additional investment to buy Treasury versus the other things to buy? And that's that crowding out. And so that was my only point of, now, you look at what President Trump is doing and trying to create some efficiencies with the government. We cannot sustain the trajectory of spending. I mean, ideally, what you do is in difficult times, COVID times, GFC, financial crisis, government increases the spending to help stabilize the economy. Right. But then in good times, you gotta pull back that spending, and we just didn't. It is so hard. It's like a drug. You just, you're in the spend. You keep spending, and it's not sustainable. So. I think some of the programs, difficult. It's really difficult to do, but we need to curb that kind of spending.
Yeah, it makes sense. It's kind of how we would advise corporates in bull markets, to take care of your cash flow and manage your finances.
Absolutely. And, corporations go through tough times. And what happens when you go through that tough time is you start to re-look at everything you do and say, number one, should we be doing this? Two, is there a better way to do it? When things are good, you don't always stop and look at that. Governments never go through that process. And so inefficiencies get built on in the system that honestly you need to sort of have a mechanism to take a look at it and say, is there a better way to do this?
Yes, no, that's perfect. So on closing, any final thoughts or advice for investors navigating this evolving landscape? It's a tricky time. Investors.
We are constantly reminded, and we get complacent on this point, but like the DeepSeek moment was, diversification of a portfolio is so important because you never know. I mean, I can tell you, and I'm sure, Lisa, you saw this, like 6 weeks ago, 2 months ago, people would go around and talk about the world and they wouldn't say anything about Europe. Like it was as if Europe didn't, they're like, oh yeah, Europe's been the best performing stock market in the year to date.
Especially the DAX.
Yeah. And so, again, diversification, that's number one. Number two, I always say managing investment portfolios is not a part-time job. Being able to keep track of all the changes going on in the world, you need somebody who is full-time helping you do that. And that's why I personally use a financial advisor. That's why you use a financial advisor.
Of course.
And so I say, don't think of it that you're going to be an expert. In bull markets, everybody becomes an expert in investing. It's in the difficult times, the volatile times, that you realize, you know what? I need somebody to help me plan through this.
Absolutely. Filter the hype from reality.
Exactly.
Right. Okay. Wonderful. Jenny, this has been a great discussion. Thank you so much. It's been an honor to be with you this morning.
It's great to be here.
Thank you for joining us for this episode of Perspectives. Make sure you're subscribed to HSBC Global Viewpoint to stay connected